Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures are rising following the June PPI report. Producer prices that showed wholesale inflation was little changed in June, helping make the case for the Federal Reserve to cut interest rates this year. But the PPI report follows June consumer price data that showed higher tariffs are filtering through into a variety of categories that include household furnishings, appliances, and recreational goods. Plus, big bank results out this morning showing record trading profits. Goldman Sachs posting its best stock trading quarter in Wall Street history, raking in $4.3 billion. And Morgan Stanley and Bank of America traders posted record second quarter for trading as the biggest U.S. banks continue to reap the benefits of market volatility tied to President Donald Trump's policy moves. Plus, crypto set for another win as President Trump says he has enough support from GOP lawmakers to pass the Genius Act. The House now on course to pass three industry-backed crypto regulatory measures during what it dubbed Crypto Week. Bitcoin and crypto-linked stocks mostly moving higher ahead of that vote. Let's get a check-in on stock futures right now. We're seeing indications for a slightly higher open here marginally. Yesterday, we saw the NASDAQ helping lead. Today, it's the laggard, right now indicating a gain of only about 0.1% at the open. Conversely, we got the Dow showing a gain of about 1/3% at the open, and the S&P hovering in between the other two. Let's turn now to our top stories of the day. Stocks are higher after PPI data shows just how much President Trump's trade war is feeding into inflation. Plus, big banks reaping the rewards of the president's policy-induced volatility and a win for the digital asset industry as House Republicans are set to pass three crypto regulatory measures, according to the president. Joining us now, senior reporter Brooke DePalma live at the NASDAQ, markets reporter Josh Schaefer, and senior reporter Ali Canal. Ali, let's start with you on this PPI data, because I know you were watching those components of CPI yesterday quite closely. What story was PPI telling us?
Well, PPI coming in softer than expected for the month of June. We did see the May numbers revised higher. All things considered, though, you were just talking about consumer prices. This is going to keep the Fed on pause for now. And if you take a look at CME futures, markets are discounting the odds of a September rate cut. We are now firmly below 60%. We had been above that level pretty consistently here. So overall, there just seems to be less conviction that we will be seeing those rate cuts. That being said, considering we have PPI data softer than expected, that's helping lift futures trading this morning. We also saw long-term treasury yields like the 10-year yield and the 30-year yield edge a bit lower, but they're still pretty elevated, and that came after that inflation report yesterday. So we have the 10-year yield hovering around that 4.5% level. The 30-year yield is again hovering around that 5% level, and these are levels that tend to pressure equity. So something to just keep an eye on here as we continue to see this data. Economists have largely said that we're not going to see the full impact of tariffs until later this summer, possibly into the fall, especially since the goalpost keeps moving when it comes to when we could potentially see these retaliatory tariffs go into effect.
Brooke, maybe the 4.5% level for the 10-year is problematic for stocks, but we have not seen the inflation data really weigh on stocks thus far.
Absolutely. What we're seeing so far is really markets seem to be shrugging off all this latest data that we're getting. They shrugged off the CPI report. They seem to be shrugging off the fact that the producer price index came in largely unchanged or flat year over year this morning. And also, in addition to that, what we saw back in June is these large fluctuations as trade deals were announced, as we got more iteration, especially in May and June, about how exactly the U.S. and China, that 30% down from 145%. We got news from Vietnam. We saw large swings there. But what we've seen so far this week is sort of a tempered approach by investors as they really understand and really, position themselves in this environment where they realize that these announcements are coming rapidly, they're coming frequently, and they're changing also rapidly as well. And so markets seem to be shrugging off not only this latest economic data that we're getting, but also the announcement with the U.S. trade deal with Indonesia on Tuesday. And now, in addition to that, these big bank earnings largely not really moving overall futures higher this morning.
Yeah, let's talk about banks, though, for a minute here, because, Brooke, I know you in particular were looking at some of the commentary around the consumer coming out of some of these banks and what they were seeing in net interest margin as well.
Julie, that was the big concern going into the second quarter earnings season, earnings quarter, I guess you could call it, is the consumer holding up in this environment where so much uncertainty has existed? We've heard about consumers pulling back, pressing pause on their spending. But what we've heard from these big banks so far is that the consumer remains solid. Bank of America CEO saying today, even on the earnings call this morning, that we saw solid consumer spending data. They saw an increase in spending when it comes to travel, entertainment, food, retail, and services. And that was the biggest nervous. That was really causing the street to fear this slowdown among consumers. But Bank of America not alone. We also heard from JP Morgan saying that the consumer basically seems to be fine. Wells Fargo also saying that consumers and businesses remain strong. And this now sort of a reprieve from what we've been hearing in the first half of this year. It's sort of a tale, a story of two different tales here. So much uncertainty that could really rock the consumer, and now we're seeing them come out on top, really remain steady here.
And so, Josh, this sort of setting the tone, perhaps, for the earnings season. I mean, this feels like what we've had in the past few quarters where the banks come out relatively strong to kick things off, and then we kind of go from there.
Yeah, Julie, I mean, earnings usually beat estimates, right? We all know that, and that's sort of course, the trend you're seeing here. But I mean, of course, there could be a scenario where that didn't happen, right? So the fact that you're having the largest banks come out and beat estimates is a good start for S&P 500 earnings. I think some folks had expected the average would be, you're looking for about 5% year-over-year earnings growth. Maybe you beat by about 4%, and then you get to a 9% year-over-year earnings growth for the index by the end of the quarter. But yeah, relatively solid start. And I mean, those comments on the consumer that Brooke was just mentioning can't really understate how important that is to the overall story as we continue to talk about the health of the economy and sort of holding on and the keys that's been to this rally, right?
I mean, what's so ironic here, Ali, as well, in these bank earnings is that, all of the angst over tariffs and the volatility it was causing the markets, that was great for the banks because they all saw this uptick in trading activity.
Yeah, great for the banks. Volatility is a solid indicator that banks are going to outperform, and we saw that in these results. We also had more pickup in deal making, and to that point, all the CEOs essentially expressed that in the back half of this year, we are going to see more M&A activity after those April tariff uncertainties kept a lot of deal making on the sidelines, but now we're seeing that pick up again. And deregulation too, that's going to be another back half catalyst that really hasn't been talked about as much as tariffs have dominated the conversation, but that's a huge opportunity for these banks. And one of the reasons why we've seen the financial sector in general trade at these record highs. It's one of the best performing sectors in the S&P so far this year.
And Ali, let's turn now to what's going on with crypto and the so-called Genius Act, as well as some other pieces of crypto legislation. The vote set today for 12/20 in D.C. The president said last night he's confident that he has the support to pass this thing. So what should we be watching for?
Yeah, so the vote slated for this afternoon, President Trump is very confident in the passing of this bill. He says it's going to make the U.S. light years ahead of China, Europe. This is going to be a strong catalyst for the dollar, which we know has struggled so far this year. But we are seeing stablecoins become more part of the mainstream economy. We have Amazon and Walmart reportedly considering their own stablecoins. This would establish a framework and is really the first major piece of crypto legislation that we're seeing work its way through D.C. That being said, though, there does seem to be some resistance. We've been talking about this bill for a while. It took a bit of time to make it to the Senate. It failed once. There's been heavy negotiations, and this was essentially supposed to be the easiest piece of crypto legislation to get through. So perhaps some choppiness here when we look at the future of crypto. But for the time being, this administration has been so bullish on the crypto space at large, and that's one of the reasons why we're seeing Bitcoin prices where they are, still hovering around $120,000 a coin.
Yeah, Josh, let's talk about the price a little bit more here because, we saw that surge earlier in the week. We talked to Andy Baer over at CoinDesk about that yesterday, and he said part of that was sort of the equivalent of short covering. But certainly, to Ali's point, we've been talking about this legislation for a while now.
Yeah, Julie, I mean, I think you could probably argue it's perhaps priced in at this point with the rally you've seen in Bitcoin. You're looking at it on your screen there. I mean, we've seen a big rally in Bitcoin really over the last several months now, touched 122,000. I mean, if we're talking about Bitcoin and how volatile crypto can be, if this legislation is going to be passed today and the coin is up less than 1%, I just don't think that's really candidly that impressive in terms of how we usually talk about crypto. But also interesting to point out, Circle stock up about 4% in pre-market trading, because of course we are talking about stable coins here as well. And that one's been an interesting one because we kept on talking about how it felt like it had that crypto aspect of a little bit of number go up as the stock was up, but it topped out, I'm looking at, on June 23rd at $263 a share. Stock is down about over 20% since that end of June trading. So it'll be interesting to see if as Circle continues to rise throughout the session once we actually open here, and maybe that stock starts to catch a bid again, because that was sort of a go-go stock for most of the month of June.
Yeah, let's talk about another stock that's been a go-go stock on occasion. That's Shopify. Brooke, I know you're watching this one, and it's not necessarily one that I think of when I think of the crypto story, but there's some developments there, I guess.
Yeah, it doesn't really come first to mind, but what we've seen with Shopify is the stock up almost 80% year over year. And what we know is that they're joining forces with Coinbase, they're joining forces with Stripe, and they're ultimately aiming to bring that frictionless, that stablecoin payments to the merchants, that they work with. Of course, Shopify being the platform that allows merchants to deliver e-commerce to their customers. And so it's been an interesting play here that certainly has investors excited as Shopify really expands and really looks to get on board with this rise of this stable coin payments. And like Ali had mentioned at the top, not only is Shopify getting in on this, but Amazon, Walmart, they want in as well, because ultimately what this allows retailers to do is limit those fees that come with those credit card payments and ultimately get those payments straight to the consumer. So really eliminating that middleman here, and that certainly has investors excited too.
Guys, thanks. Brooke, Josh, Ali, talk to you later. The shares of Johnson & Johnson rising after the company beat sales expectations and raised its full-year outlook. The results are positive for an industry that's facing down a tariff threat from President Trump. Here with more, Yahoo Finance senior health reporter Anjali Kamlani. So give us the details there on J&J.
Yeah, Julie, as you mentioned, the stock up, but just slightly, and surprisingly so considering the level of beat. We know that the company has been under watch by investors and analysts for the last few months because of the tariffs, to your point, already impacting the med device segment of business. There we saw a beat of $230 million and a decrease in terms of the amount of impact. Earlier on, we saw about $400 million from the company as an estimated impact, and they revised that down to $200 million of impact in tariffs. So that's really good news there. Meanwhile, looking at the numbers straight out of the report, earnings, they beat on by a little bit. They were expecting $22.8 billion and then saw $23.7 billion for the quarter, and then adjusted earnings per share at $2.77 versus $2.70 was the expected. And so that beat really good, giving a positive impact to the stock, but not so much. And I think this speaks to the other part of the equation, which is what is going on with their portfolio. We know that J&J is not immune to the scrutiny that large cap stocks have been facing in terms of their revenue, their potential patent expiries. J&J already saw some erosion from Stelara, that's its psoriasis drug, and that is one of the impacts. I did have a chance to speak to Chief Financial Officer Joe Woke earlier today about how the company is thinking about it, and he says that with a strong balance sheet, the company doesn't really have to do much to fill the holes. So listen to what he had to say.
One of the great advantages, I would say, maybe it's the pleasures of being Johnson & Johnson's CFO, is that we don't have to do a deal out of desperation to fill a revenue gap. Look what's happening right now. Stelara eroded $1.2 billion from the second quarter of 2024 compared to the second quarter of 2025. The rest of the portfolio grew 15%. And so most companies would be either pausing growth, if not contracting. Here we are growing as an entity 5%. It really speaks to the broad diversification of Johnson & Johnson.
In addition, the company has deployed about $55 billion in capital in deals to kind of make up for the expected loss, and $10 billion of those deals have been in smaller deals. So it's looking at both large and smaller deals in order to help fill that gap. And so whether or not the street really accepts that and isn't just going to put it in the box with all the other large cap pharmas and wait to see whether or not that pans out is why you're seeing a little bit of slow uptick in that stock this morning.
And Anja, at the beginning, we referred to the tariff threats that have been ongoing, right? You and I have talked about this before. The president giving a little bit more detail, floating things like that there would be a phase-in period, et cetera. What should we be paying attention to there?
Yeah, so the president has talked about that. The companies have already, especially Johnson & Johnson, committing that $55 billion in manufacturing to kind of help slow down. Joe Woke did tell me also that he's pleased by the fact that the administration has been really interested in conversing with the companies about the potential impact. And that is where you're seeing this sort of slowdown and this sort of delayed phase in. The president saying that there could be about a year and a half gap between when the tariffs could phase in. This is based on a different sort of strategy looking at national security, so that 232 investigation versus straight up on numbers country by country. And that's what the industry is sort of bracing for, is how high will those tariffs be, whether or not they can do even more to convince the administration not to put in those tariffs or to make it so small an impact that they don't have to worry about it. And that's something that the industry is ongoing lobbying for, with the discussions of these huge manufacturing commitments, as well as ongoing discussions about what they plan to do with the U.S. market and separate it out from their abroad market.
Anjali, thank you. Appreciate it. Coming up, we're going to count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We're watching ASML, HPE, and Diageo. First up, ASML is warning it cannot confirm growth expectations for 2026 as the Dutch tech giant grapples with the impact of U.S. tariffs. The company narrowed its guidance for the remainder of this year after the outlook for the current quarter fell short of expectations. ASML is crucial for the semiconductor supply chain. Its machines make advanced chips for the likes of Apple, NVIDIA, and Intel. Next, Hewlett-Packard Enterprise announced a slew of business changes after agreeing to work with activist Elliott Investment Management. HPE appointed a new member to its board and formed a new strategy committee tasked with identifying opportunities within the company for further value creation. Elliott has reportedly pushed for HPE to replace CEO Antonio Neri, who's been at the helm since 2018. Elliott has built a position in HPE worth more than $1.5 billion, making it one of the company's top 5 shareholders. That's according to data compiled by Bloomberg. Finally, Diageo CEO Deborah Crew has stepped down after just 2 years at the job. The spirit maker, home of brands like Johnnie Walker and Guinness, announced its current CFO will take over in the interim. The company said Crew's departure was a mutual decision, but did not give any other details. Diageo, which is in the midst of a turnaround push, said its forecast for fiscal 2025 and 2026 remain unchanged. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, President Trump's promises for steep tariffs on some of the U.S.'s biggest trading partners triggered a market sell-off in April. But after those tariffs were paused, markets returned to all-time highs, with NVIDIA powering the Nasdaq to new records during trade on Tuesday. So will enthusiasm for the AI trade outweigh trade concerns? Joining me now, Alex Morris, FM Investments CEO and CIO. Alex, in a recent note, you were getting a little philosophical, I guess, here. But I thought something you pointed out was interesting, which is that momentum in the market does not necessarily reflect some amazing underlying sentiment. Talk to me about that.
Yeah, I think what we're seeing with equities hitting new highs isn't, it's a little bit of irrational exuberance again, but that isn't folks just saying the outlook for the world is great, let's buy U.S. equities. I think this is a simple supply and demand imbalance that's happening against a backdrop of some pretty noisy geopolitical information, whether it's, actual hot wars in the Middle East, whether it's taco trade and tariff talk, whether it's the government taking a victory lap and calling itself really smart today by signing a law called the Genius Act. There's a lot of sort of discordant things happening that might make some people feel great, but we don't think that's the average temperature in the market. What we do see is a lot of flows still coming in through index funds. We see retail swinging things around much more than they ever have before. Now, even more so because of the prevalence of highly leveraged ETFs in the marketplace. And as a result, I wouldn't interpret equity highs as deeply positive across the board, but that doesn't mean that you can't ride momentum, make some money while the trade lasts.
Well, and does that also imply that if there is true optimism that is unlocked, right? If some of those things that you mentioned are resolved in what the market perceives as a positive way, that you could even see more upside?
Absolutely. If we are able to actually bring in a tariff policy and a trade policy that works and it isn't going to be overly inflationary, that would be great. We have some headwinds, though, we have to fight. We have some current, fiscal policy that looks set to either A, not actually be resolved, as we talked about shutdown coming a month or two down the road, or at least the potential for one. And then we have a $2 trillion bit of stimulus that we're going to shove into the economy that we're going to hope somehow isn't inflationary, and we don't have to have more Fed intervention to overcome that. So if we can overcome both those, and they're big but not intractable problems, there's a lot of upside for equities, and there's a lot of upside for the dollar regaining some of its strength.
Alex, can you talk to me a little bit more about some of those technical factors that you think are responsible for the market increase? You mentioned fund flows into index funds and retail trading, but what is driving that? I mean, is it just that people have a lot of money to invest and it has to go somewhere?
It's a nice problem to have a lot of money to invest. And I think that's generally true. We've seen a lot of cash on the sidelines, and certainly a lot of cash in money market funds, and sort of worryingly more cash in bank accounts than we're used to. And those numbers, round to 20 trillion. So it doesn't take a very large percentage of that to start to edge back out into the markets to really see some pretty meaningful flows. And we think that's definitely happening. But then we also see a lot coming into short-term treasuries. We see a lot coming into our T-bill, X-bill, and O-bill products on the short end of the curve. So there is some interest in getting out of pure cash, but not necessarily equities. But as we talked about, let's view have a retail investor who comes in and decides, I'm not going to just buy the market. I'm now going to buy in through a fund that has options that are 2 or 3x the market. They really have this amplified effect on short-term price movements. And those won't last forever, but that does sort of beget some, mental stimulus as folks say, oh, I see new highs. I want to chase them too. Now, these highs, by the way, aren't the same as we saw earlier in the year. We're now looking at highs that are fueled, again, sort of 2024 style. Mostly tech, mostly NVIDIA, mostly Mag 7 names that are starting to do the brunt of the heavy lifting again. And when that happened last time around, many of us started talking about market structural concerns. And some of that will come back. But this feels more like a short-term pop, the sort of sugar high of summer holiday, than it does a structural change in wind that the stock market is going to go back to just always going up and to the right on all of our charts.
Yeah, Alex, we'll check back in with you soon to see how some of these situations turn out. Good to see you. Thank you.
Good seeing you.
Coming up on Yahoo Finance Opening Bid, our own executive editor, Brian Stasi, is going to be with us. Oh, and he's with us now. What's coming up? Quickly.
Yeah, Julie, real quick, the big bank stock blowout. We're all in on bank earnings and which name you should own in the back half of the year after really strong results for the sector.
All right, looking forward to it. That does it for Morning Brief. Much more ahead on Yahoo Finance.